Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Brooke Major-Reid, Chief Capital Officer at Affirm. Affirm made its name as one of the premier BNPL or Buy Now Pay Later platforms, and as you'll hear today, they are clearly much more than that now. So thank you for joining me today. Brooke, I really appreciate it. How are you?
I'm great. Thanks, Todd. Thanks so much for having me.
Of course. So if we can just start maybe at the high level and a little bit about your journey, tell the audience a little bit about your role, Chief Capital Officer, and ultimately how did you end up at Affirm?
Oh, happy to. Thanks for asking.
Of course.
So I'm the Chief Capital Officer, as you mentioned, here at Affirm, and I'm responsible for managing all of the funding activities related to our lending business. So all the loans we originate, they need to be funded. As you know, we're not a bank, so we are what we call wholesale funded. We use a little bit of our cash, but largely we enter into partnerships and structure deals in order to fund the loans we originate. I also manage our treasury, typical corporate treasury activities, as well as risk and analytics for the funding and cash management ecosystem. My journey to Affirm really started out with being a student of finance and banking for a very long time, and really felt drawn to the mission. When you think about where you want to build your career, you want a place that's high integrity, doing things the right way. And I've been very fortunate to be associated with organizations throughout my career and learned a lot, that have, in my opinion, been hallmarks of good business and practices that I'm really proud of. And the mission here at Affirm, the fact that we're focused on the consumer and offering financial products that improve lives, I think for me, that was a huge attraction. And of course, the culture here at Affirm is among one of the best that I've experienced in my many decades of working.
So I know in my intro, I referenced where Affirm started, very much BNPL, but where is Affirm on that journey today? Are you significantly more diversified than say 5 years ago? And kind of a secondary question to that, younger consumers in particular, I think, at least from my point of view, kind of have viewed BNPL as maybe that new age credit card. They're fearful of fees with credit cards, and they've kind of gravitated towards this space, which gives them, I think, a little more flexibility when they're making purchases and doesn't necessarily load them, with a credit card balance that takes forever to pay off. Are you seeing the same thing? Is that some of the motivations behind the growth of the firm?
Yeah, that's a really, really interesting question and observation around it, Todd. I would say two things. One, when you think about the technology surrounding what we do and the advancements in the market around sort of digital applications to managing one's financial life, it's really important to note that folks are voting with their wallets, so to speak, and their digital device. So in some respects, Affirm is early and also very far along. So when you think about the growth we've been experiencing in the market, that's driven by consumers who are saying, you know what, I want more control. I want the ability to manage my financial life in a way that feels authentic to who I am and what I want my financial picture to look like. So stepping back, Affirm offers, in terms of the lending products, a broad range of offerings from 0% sort of short duration installment loans, pay in four, and also longer term installment loans out to 60 months. And when you think about what that does, is that really speaks to a consumer in terms of where they want to be on the financial spectrum in terms of either highly considered expenditures or just everyday expenditures. So we can meet the consumer where they are. And going back to your point about sort of younger generation, early career folks, I think it's broader than that. So we are seeing that trend, but I think in general, when you think about the credit card debt and how vulnerable folks are to sort of just not making the full payment and not able to make the full payment, this is really a much better transparent option. Again, we don't benefit with folks falling into a rough patch, so we don't charge any late fees. There's no reactivation fees, and majority of consumers tend to revolve on their credit card. Ours is an amortizing product. So all those features and the structural advantages we have around sort of underwriting each transaction really speaks to the power of control. Having merchants, get more consumers that are able to repay and repeat. And from our end, the consumer feels like they have a lot more control over their financial picture. In 3, 4, 6, 12 months, they know that balance will be paid off. And there's a little bit of sort of, celebration around. So, you know what? I just paid off this Peloton or this Amazon purchase or whatever it is. And that feels really good. And you're not sort of in this position of revolving on credit card debt just because you aren't able to pay the full amount.
Ultimately, do you, and by you meaning Affirm, do you view yourselves as a lender, a payments network, a platform? Like, is there a kind of a, my knowledge of Affirm has always been, kind of probably more on the lending side, but is that the way you view yourselves?
Yeah. So if you've heard sort of Max and Michael and Rob on our earnings calls, we really think of ourselves as both.
Okay.
We're a payments network that responsibly extends access to credit by underwriting, as I mentioned, every transaction before making a real-time decision with a consumer. And all payment networks are inherently credit networks. So there's a level of risk you're taking, be it settlement risk or enabling the consumer to pay over time like we do. But Affirm is really a flexible and transparent alternative to many credit cards and other pay over time options. So it's really both.
Got it. Speaking a little bit more to our core audience, which is, very much the, the credit funds and those that help, fund these loans. You have a number of large, well-known funding partners. What ultimately makes the Affirm, book of loans, so appealing to institutional investors? I know that you have a partnership with Sixth Street and many others. Is there a particular thing that makes the loan so appealing?
Yeah, Todd, that's a really good question. And I'd like to say we're really nice people here in Capital. So that's an attractive part of why people like us. But alas, that's only a small part of it. But it doesn't hurt. But I think there are three key reasons why our capital partners are attracted to us. One, we have technology-driven risk management. So our underwriting, all of what we do, we sort of put together all the signals, and we're able to sort of underwrite each transaction based on sort of the qualities of the consumer and the transaction that they're trying to execute. And we also, the second thing is our assets are short duration with a weighted average life of around 4.5 months. Firm's assets offer a really attractive risk profile and consistent turnover. And really, the loans don't need to withstand multiple credit cycles. And so we're able to react very quickly into signals that we're seeing in the market. And I think that's really attractive to investors when you think about, being exposed, unlike sort of credit cards, the longer duration, it's harder to sort of respond when the portfolio is experiencing either inherent headwinds or macro adjustments or volatility in the market. And three, we offer very consistent risk-adjusted returns. We're able to generate these quality assets at scale, given our growth, and we've become known for the credit performance of those assets. And I think that's the number one thing. If fundamentally, you have to have the appropriate risk-managed approach and risk-adjusted returns that attract these investors. Otherwise, it's very difficult to maintain the stable and quality of partners that we have. And I should have started out by saying we're very grateful and very fortunate to have a very diversified stable of both asset-backed securities investors, but also bilateral partners, as you mentioned, one of them, Sixth Street, but so many others in our ecosystem who have stuck with us because of those characteristics and features of our loan book.
You mentioned volatility there, which kind of leads me into my next question. Obviously, today we're in a pretty volatile time. It seems like there's something making news every couple of minutes. But you mentioned the short duration and clearly the risk-adjusted returns for your funding partners. But on the other side of it, your side, do you have to think about partners differently when you're looking at a more stressful or a more volatile environment?
That is a really, really good question. And it takes a lot of discipline to do what we do with the intention and the focus when things are just sort of moving outside of your control, right? And so whether the volatility is related to some sort of secular macro trend or other trends in the market that you don't necessarily control, you have to think about what that means for partners. So we step back and we say, regardless of the environment, it is imperative for us to be partners first and foremost with our capital providers, which means that we typically have a very long onboarding sort of dating cycle. We rarely, if ever, refer to our transactions or the executions we carry out or undertake as trades. We basically have the discipline to say, these are partners of ours who are trusting us with their capital, and we trust them to be there. So whenever we have any periods of volatility, any drifts in the market, we tend to have a very good track record of partners sticking with us because they know that we are dedicated to the fundamentals of the business. So we don't really have to think differently. We never take anything for granted. Credit is always job number one. And so as you go through that cycle, folks know that you're really ensuring that there is proper risk management around the loan books. And again, the short duration helps with that. So to answer your question more directly, don't think about partnerships and transactions differently depending on cycles. My opinion of you and your opinion of us shouldn't change because of the circumstances. It should change because there's something that we both agree isn't necessarily working long-term for the partnership.
What about the kind of a secondary piece of that, which is, you're now a public company and you have been, for a little while. Does that limit the number of partners you can work with? As you're scaling up, maybe you're working with some smaller funding partners or bigger funding partners. Is it, kind of a certain size and scale now, given your size and scale, that you're a publicly traded company, or do you still kind of have that nimbleness to work with a variety of funding partners as long as, your goals are achieved, their goals are achieved?
Yeah, Todd, that's really an interesting point. One, we've sort of challenged ourselves with over the last, I would say, 2 years as we've grown with respect to GMV and just the amount of partners that we've been onboarding. I would say that we have not abandoned what's worked really well, the risk management, the diversification. So we view the partner lens as folks who can scale with us over time, but the right kind of capital that we can rely on on a committed basis. So in terms of all of the things that you've mentioned there, as a public company, we continue to have a diverse mix of capital partners that support us, but the way we access that capital may change over time, just like we did with Sixth Street, just like we did with our master trust. So we continue to onboard large, scalable partnerships, but at the same time, there are folks in our ecosystem that we very much want to continue to have a bilateral relationship with, in size. There are newer partners who we've attracted, and we've worked really hard to meet them where the capital is. So we've done things like pass-throughs, block sales, in a way that those partners can sort of be onboarded, but scale across the platform. So you may have a partner that started out in forward flow, maybe a smaller relationship, but now they're expanding in ABS. Maybe there's also warehouse lines. So the primary objective of my team here in Capital is to fund the business in a stable, resilient way through all cycles. So that means we have to have respect for every dollar of capital that is afforded to us. And if that means working with a partner who is truly a valued partner, we need to meet them where they are in a flexible way. So you'll find us thinking about striking the right balance between sort of maintaining access while efficiently deploying the capital we have over time.
ABF, or asset-based finance, has clearly taken on a bigger part of the market as private credit has grown. ABF has grown with that. Have you recently seen a lot of newer names in the market, or maybe you didn't see as many insurance companies or pension funds that might be interested in this type of asset? Are you seeing just the optionality today greater than 2 years ago? And does that, is there a learning curve to some of the newer entrants in the market?
Yeah, I think it's an interesting point in terms of whether they're new or not. I think the pockets of capital within existing institutional players has evolved. So you may have a player who has been in the market for a while, maybe entering consumer and has a specific pocket of capital that they've allocated to private credit. But for a very long time, even predating myself, we've seen activity around some of the larger, well-established institutional capital through insurance. You've probably seen our relationship with CPP. Yes, there are other entrants, but I think the folks we engage with tend to be extremely savvy and have a familiarity with either consumer assets or just structured finance assets in general. So while there are newer players, I think there's also this notion of established institutional players saying, here's a pocket of capital that they can dedicate to alternative or private credit allocation to get at more attractive returns. On the sort of private equity side, or more on the core quote unquote private credit side, I think we've seen pools open up to us that may not have historically been there a couple of years ago. But I think the trend is more generally that folks really want good, stable performance. They want value, and they want to make sure that whatever capital they're putting to work in whatever segment of their investment portfolio, that it's going to get a good risk-adjusted return.
Is there a common worry amongst investors, or I guess another way to put it would be, is there a kind of a theme that you've seen them, come up more in conversations, whether it be new partners or old partners? Is there a common theme, like, what if this happened? Or, if we went into a recession, do you perform as well? Like, have you seen a common theme or worry? We've talked a lot about, the short duration and risk adjusted return, but on the other side, maybe is there a worry that, investors are at least asking about?
Yeah, what we've found is that folks tend to come to us and say, "You guys get really early signals. What are you seeing?" Because of the short duration of the asset. We don't generally have folks saying, "Well, what will happen if?" I think we've proven ourselves consistently, and again, going back to the long process of getting to know each other and understanding what we do well. And so very rarely do we have folks coming to us in a panic saying, "Well, what if this happened? Have you, adjusted the book for this or that scenario?" It's more of an engagement around how are we thinking about either growth or credit in a particular environment, and they just want to understand how things are evolving. So the conversation is really around how are you viewing the market in terms of what you're seeing in the book, given the short duration, and it's really a part of the partnership that allows us to sort of have that open dialogue without having this sort of reaction to every blip or sign of volatility. And so the thing that we rely on is ensuring that we have those signals, we understand them, and we're able to articulate proactively to our partners what we're seeing and how that may affect them. But rarely do we have a conversation that is so broad and laden with worry around how we're going to perform through a cycle, just because they know us really well and they understand the structural advantages we have through underwriting each transaction and just the short duration of our assets.
Specialty lending or fintech lending, however we want to describe it, has kind of, really taken, a good hold of the market since the GFC. Banks exited, these fintech or online lenders kind of entered the market, they provided a service, then the likes of Affirm and others have stepped in, kind of varying what the credit products might look like. Kind of a two-part question. Are those motivations similar today in that banks are still not lending and this group of new age lenders has, filled the void and continue to fill that void? And then the second part is, private credit and pay over time are clearly converging, and they're converging rapidly. What do you attribute to this expansion that we're seeing today?
Yeah, in terms of the convergence, let me just deal with that. These are mega trends, and we're sort of in a position where our strong credit performance and long-term partnership approach have enabled us to attract some of the most sophisticated partners in the world. So as you look at what's happening, private credit and a lot of capital providers are saying, who can really adjust and be nimble in this market? Now, with all due respect to banks, hard for me to say that they're either, lending or not lending. I think there's always a market and a price for risk. And I just think when you're sort of a larger, more established banking institution, it's hard to be as nimble. So, they're meeting customers where they've always met them, with a credit card product. And as you can see, there's sort of pay over time options now in credit cards. So on, your typical revolving credit card or even charge cards. So there is this notion that there's more at the table for different types of providers. But I think the market is distinguishing between those who can do this really well. And so as a startup, if you are offering a product, it has to be compelling, and you have to be able to underwrite regardless of what the duration of your product is. So yes, I think banks are still lending in the ways they always have, and they're innovating on the margin. But when you think of capital providers, they want broader access because there's capital flowing into our ecosystem, as you mentioned, through private credit and other means, that they're looking for quality assets. So the expansion is real. I just think when you're technology enabled, you're a company like us who's able to demonstrate that performance, it creates an opportunity to broaden access to credit in a way that's healthy and responsible. And that in turn gives capital providers more confidence to put their capital at work, and hence consumers having broader access to credit in a responsible way outside of what a traditional banking institution or credit card product would have.
A couple of lighter questions as we're coming to our end of our time together. So first is, do you have a favorite sports team or hobby?
Yeah, I'm at risk here. So I'm originally from the Caribbean. I'm going to stick with my Jamaican soccer compadres, but I don't want to be at risk here of putting out a U.S. team. I think I'm safe with going way out to the Caribbean Sea. But I'm a soccer fan. My boys play soccer, and they root for different teams, so I won't even go to any of the European leagues there. But I'll just stick with my home country and love for soccer. So,
tell us one surprising thing about yourself.
I used to swim competitively, and so as I call it, at a certain point in my competitive life, I became vertically challenged. I wasn't going to grow anymore, not grow any taller. And as you can see from all of the successful, awesome, competitive athletes in swimming, they're slightly taller than 5'1", but I did my best.
What's the most exciting part of your job?
Oh, wow. I would say working with the capital partners directly and the awesome team here at Affirm. I have had the privilege of working at some really, really great institutions, and throughout my career. I feel incredibly grateful. I would say that at Affirm, we have some of the smartest, best talent, collaborative, thoughtful, and really in service of our mission. So when you talk to people here about why they're here and why they stay here, it has a lot to do with the mission and the culture. And so getting to solve problems, innovate with folks who are so smart, and I'm learning a ton from them each day, and hopefully they're learning from me. That's really, really exciting. And to see our capital partners just support us. We have never had, a situation where a capital partner, was unhappy to the point where they've abandoned us, or there's something that didn't go well and we couldn't have a conversation. And so it's really exciting to be in those moments with both the affirmers and our capital partners at the table.
And final question, one prediction over the next year.
Yeah. So if I could predict stuff, as much as I love Affirm, I'd probably be somewhere, again, in the Caribbean Sea full time. But I think, one of the things that I'd say is that, the markets are evolving. And who knows, as you mentioned at the outset, that there's a headline, almost as frequently as you look at your Apple Watch or device. But I'd say that one of the things that I could predict is that we will continue to provide responsible access to credit here at Affirm, and that we will be able to offer products that provide value for both our merchants, our capital and our consumers, and thirdly, our capital partners. So we never take anything for granted. And I look forward to continuing to build those long-term relationships with capital providers. Will there be moments in the market where, folks may have more of a concern about one thing or another? That will probably always be the case. But I think the ability to demonstrate the discipline and just the approach around technology and risk management, I think that's going to be important. And I predict that we'll continue to be able to do so at scale.
Well, Brooke, I really, really appreciate you coming on the show. It's been great to catch up with Affirm and kind of hear where you guys are, where you're heading, and I really appreciate your time. It's been a great conversation.
Thanks so much, Todd. I really appreciate it. Thanks for having me. Have a good rest of your day.
Of course. Thank you so much.